Hello everyone and welcome to Jim Dalton's presentation as a preparation for the intensive starting next week. It is June 30th, 2014. It's 11:30 a.m. Eastern and we will go till about 1 o'clock. As always, this is being recorded and questions are welcomed in the question box there on your dashboard. And Jim and I would like to thank everyone for taking time out, especially during trading, to be a part of this. And we think you'll enjoy it and get a lot out of it, even for old-timers. Jim's got some neat stuff to share. So with that, thank you very much, and great to have you. And I will introduce Mr. Jim Dalton.
Hey, thank you. Good morning. We've got an opportunity with, we'll do the preparation for the 30-day intensive, but at the same time, S&Ps are still trading. So there'll be some times we'll switch back and forth and take a look at that market, and particularly reference that market to some of the things that we're talking about in the intensive. Okay, our process, and one of the things that's is really neat is having Julia as a partner. Sometimes I go through this and forget some of the things that are important. She was very instrumental in putting these slides together. And if anybody had seen the presentation for the 60-day intensive, some of the slides you'll see later on because some things don't change. But some of the slides placed up front are really the creative design of Julia. Two of the things that we suggest that you either read for the first time or you review if you've already got them in your arsenal are two books: The Power of Habit, Why We Do What We Do in Life and Business, and Thinking Fast and Slow by Daniel Kahneman. Kahneman was one of the economists awarded the Nobel Prize along with his partner, who's now deceased, for some very important economic thinking that is very relevant to what we do. The Power of Habit came to us through a recommendation from a client of ours in Romania that works very instrumental in a very large bank, but it's a book that he bought for all the senior people that work for him. One of the things that you will find important when you go into the Power of Habit is that we don't get rid of, we don't unlearn old habits. What is important is that we establish new habits, positive new habits, to replace those old habits. But they don't go away, which is one of the reasons sometimes when we get under stress, even though we've learned new things, sometimes we make big errors because we revert back to things that we used to do. Even if they didn't work, they give us a certain comfort area. So I think going back and reviewing the Power of Habits is very important, and we all know there's a lot of mistakes we make in markets that we've made over and over again, and they come as a result of some very bad habits that we have become ingrained in our minds. Thinking Fast and Slow by Daniel Kahneman really has a couple of things that are very important. One, he talks about two ways of thinking. System one, thinking fast, and system two, basically thinking slow. Most of them couldn't get through life without relying upon system one. System one is the fast thinking. We jump in the car, we see a kid on a tricycle out of our side view mirror, out of our vision, and there's certain things that instincts just take over. And without those instincts, we'd have a terrible time navigating every single day. However, one of the other things we find, and that Kahneman here really confirms, is there are some very strong cognitive weaknesses and biases in System 1. That System 1 isn't as reliable as we think it is. System 2 is more plotting. It's more plotting, requires much more thought, and it's a slower process. And I'll try and give some examples of these as we move forward today. And you're going to see that everything we talk about is one way or another related to information that you see in these books. We just got a letter or an email from someone that says that they won't be attending the next this intensive. They've attended a couple in the past, and they said their market thinking has surpassed their self-understanding. I think the two are very much tied together, and we'll see that here shortly. So I think the thing we hear from very successful traders is that you can't get enough of what we talk about. That you go back and continually reinforce many of the things. Let's move forward for a second. One example in here, we got an email the other day, and it said, "What is acceptance?" It was somebody said, "I hope during the next intensive you cover more of what is acceptance. How do I know when acceptance is occurring? Is there an article on this?" And acceptance, like any other ambiguous concept in the two-way continuous auction process, can be mastered by how you think. And it's not, so many times people talk about, we use acceptance all the time. And obviously if something looks down below yesterday's low and gets kicked out very quickly and leaves single prints, that's not acceptance. It was kicked out, it was rejected. It's a very positive sign, at least in the short term, that the continuous two-way auction process is going to move higher. However, there's other times when it can be a little more ambiguous, and we saw that the other day, and we'll see it again here in just a little while, when the market had taken out the all-time high, which was set in an electronic session. As we say so many times, it is very rare that a long-term auction terminates in the electronic market, or that the overnight high or low, or electronic high or low, serves as the final high or low in any auction. So we're going to be talking more about this idea of how do you think about things. And for example, just use acceptance as an example. Let me skip forward for a second, and let me come back to the point I was making. If you look at the graphic in front of you, the all-time electronic high was taken out in D period. Now, following D period, EF stayed up there. One of our clients was very frustrated because he said, well, prices were getting accepted up there. And when the market broke later in the day, he was very frustrated because he thought he had it, the market had gone up. We'd taken out the all-time electronic high, and the market was moving sideways, showing acceptance. Well, what I want to do is talk here about how do you think about this, because there's never one simple concept at play. Many of you, we have gone over this example in a webinar because it's important. I also wrote this example up, so there is a daily report that's sent out that covers this in some detail. But let me just bring this idea forward about how do you think about things. Okay? Yes, we saw the market going up to the all-time electronic high. We saw it taken out. But at that point in time, you got to say, wait a minute. We've just taken out the all-time electronic high. And one of the things I wrote, that it looked to me that morning that this was simply a game being played by the short-term traders. And the game was going to go up and get the all-time high because they could and because there was no resistance. But once they got there, then it was side over, game out, for at least right there. And that's what makes trading difficult. There's never one single way of thinking. So at this point in time, you've got to be thinking, okay, we took out the excess high. Now you're moving sideways, and yes, you could say it is accepted. But another way of thinking might say be very careful, because the trade location, and one of the things you'll hear from us more today, say that trade location is the best risk control tool that you will ever deal with. So trade location, you've just looked above the all-time high, and in the market's continuous two-way auction process, if you don't get continuation among the all-time excess high, so in other words, the auction went up until the last bidder bid, and if you don't get more acceptance or more bids coming in, which way is going to be the next downward move in the continuous two-way auction process? Well, you got some acceptance here for a period of time, but you also had an all-time excess high. Oops, don't ask me what happened. Then, as you can see, the market broke down and at one time frame lower the rest of the day. There was other things you could be thinking about in the morning. That you had a low from Friday, and then the early Monday low exactly tagged the early Friday low. So at that point in time, you can be thinking, well, wait a minute. There's acceptance. Yes, we've got some acceptance up here, but then we had rejection above the all-time high. We do not have high confidence that these two are matching lows, so that's not a high confidence low. And I grant you that there are a lot of things that you need to be thinking about. And one of the things we're going to introduce here just in a couple of minutes is this idea of sequencing. But it's really what we want to do during the intensives is give you a way to think about trading and think about the markets. Okay, so here it's what the intensive is. It's a guided tour through the continuous two-way auction process. We want to help you develop a way of thinking about the market and the behavior of the other traders who are your competitors, to advance your ability to approximate the odds of trades that you are already in or considering. Now, I'm going to show examples here in just a second, but one of the things that I read a long time ago, and that was that we really, as human beings, we are not very good. It's not instinctive for us to be able to think in terms of odds, and our minds aren't constructed that way. I bought into that concept. I've read it, and I've seen it multiple times from very respected people. But, you know, the other day I got thinking about this and saying, you know, and I was reading another book and something triggered in my mind and say, well, wait a minute. I don't think that is correct. The example I used the other day, if I am going to go to the airport, if Julia is flying in to Phoenix and she's going to be coming back here before too long to attend a program over in Chandler, Arizona, which is just outside of Phoenix. But if I'm going to go to the airport and pick her up, I'm dealing with odds right there. And I'm approximating how long is it going to take me to drive to the highway. Is there construction on the highway? Am I rush hour or non-rush hour? Okay, we approximate odds all the time, and that's what we need to do in trading. They're not going to be exact, just like I'm not going to exactly know what time I get to the airport. If I use you know, one of the mapping services, it'll tell me it's going to be 47 minutes, but we know many things can go wrong, that it may not be 47 minutes. But it gives me an approximation. So we're going to talk a little bit more as we go through the intensive, continually talking about approximating the odds. The example we just talked about had a lot to do with odds in it. And that was, we said, okay, Monday's high and Friday's high, I'm sorry, Monday's low and Friday's low were the same. Immediately, I know that that reduces the odds of upside continuation. It doesn't take them to zero, but it reduces the odds because it really wasn't a high quality low built with a lot of confidence and a lot of new money buying. So I'm constantly doing that. Constantly appreciating trade location and how this is the most effective risk management tool at your disposal. You just saw an example where we're at the all-time high. That's the new trade location. And at that point in time, you've got to start to factor in, now wait a minute, what's going to happen? I've just made a new all-time high. If I don't get upside follow through, what's going to happen relative to the continuous two-way auction concept? And again, we're going to appreciate the concept and importance of sequencing. We'll talk more about that. But when we made the new all-time high that we just looked at, the morning report that I put out that morning listed positive factors and negative factors. There were, I called it conflicting information. There were things that I thought would make the market go up, things I thought would make the market go down. And what was important to me was the sequence in which they happened. Did the positive things happen before the negative things? In the case we just saw, the positive things happened first. Once those happened, the sequence changed and we came down and we took out the lows. And so all of those things came into play, but it was the sequence in which they happened. Tied into that is, so we're just talking about sequencing, it's the order in which things happen. It's the hierarchy of data. How do we prioritize these observations? In the example we just saw, somebody was frustrated. They wrote in and said, but I'm getting acceptance up there. Well, the hierarchy of data, the acceptance wasn't the number one thing. The rejection just above the old all-time high now became the priority, the hierarchy of the data we were looking at. So things are constantly changing. It is true that one of the things that makes it difficult for people to trade is people don't like change. However, just think, if there were no change, there'd be really no opportunity when you are trying to identify trades. I mean, without change, there are no trades. Okay, then it said, identify, if possible, a ruling reason. For those of you that got the morning report I put out on Friday morning. Now, first of all, there was the report that I put out the night before for Friday, and in that report, I said there were two distributions from Thursday. My reference was the do I stay in or get outside of the upper distribution. We treat each distribution as a separate day or auction. By the time I wrote the morning report on Friday, I wrote that my ruling reason was the overnight high, the overnight low. So, and I wrote the word, my initial ruling reason. Now, one of our clients was very frustrated because what I wrote the night before and what I wrote in the morning was slightly different. Well, things changed. It turns out they actually were both pretty close together. The overnight low was pretty close to the separation between the two distributions. So, I mean, if you take that as a bifurcated day, they were pretty close together. But my ruling reason on Friday morning was that overnight inventory was very short. And we've been following this, and we've noticed over the past 3 or 4 weeks that there's been a counter auction to overnight inventory almost every single day. The only exception going into Friday that I remember was there was no counter to overnight inventory on the last monthly employment number. Okay, now let's stop here for a second. Let's go to the market. Let's go to today. The reference that I gave today and my initial ruling reason for today was the base of the spike from Friday. I said any significant change was going to be relative to the base of Friday. And you'll see that the early morning trade was within one tick of that base. Call it one or two ticks, depending if you used the absolute base or if you use DM. It's immaterial. It's one tick. But at that point in time, it's out to me. Came with it on my own. Juliet gave it to me. But
Jim, excuse me. Could you repeat what you were just saying? You I don't know if it was for everyone else, but your voice went out, so just reset from just after the spike comment.
Okay, the spike comment, and something I don't know if it's something I read, something came to me, or something someone pointed out or Julia pointed out to me, but it hit me like a light the other day that a lot of times people use algorithms or they use other mechanical systems. This reference of the base of the spike, to my knowledge, will not come up on any other system or approach, and we're not systems traders, but any other approach to the market other than what we do. Now, the significance is, why is this important? Again, this is a way of thinking, and we said what we want to do here when we go through the intensive is help you think about the market and also think about those people that are your competitors. Remember, every single person out there is trying desperately to take your money. Now, what happened on the base of this spike on Friday? Something changed in the market. The behavior of the market changed late in the day as we moved above the early morning high. Now, whether it's lasting or not is immaterial. A change took place. A change in attitude, a change in sentiment about the market. Remember, trading is about change. So unless we trade back down below this and get accepted down there, there is no change in market direction or market sentiment relative to what took place on Friday afternoon. So if you're in there and you can sit there and say, yeah, but I'm going for this very prominent point of control, it's got to retrace that, right, Jim? I said, no, it doesn't have to do anything. This is something that builds into my odds. You know, I said, okay, that reduces the odds of upside continuation, and we know there's a tendency to come back and revisit these things. I know I've also got another one down here that hasn't been revisited at 1942.50. But that may be information I have to carry forward and information for a later time. If I come back on another example, we have been using the base of the spike following Fed Day as a major reference. And again, that's the same concept that we just talked about on a daily basis. And we said, unless something changes, unless you get acceptance down below this level, we looked below it one time last week, and it's right here. It did not get accepted. It got rejected. Unless we get acceptance down here, there is no change relative to what took place following the Fed Day. So the trends all remain up. People are still buying the breaks, and the overnight low on the previous day was one tick above this. As you can see, the next day on Wednesday was one tick above it. Thursday looked 3 ticks below it, and of course, Friday we got down to the halfway point, just about the lower portion of the. If we divide this into two distributions. So that's been a very solid reference for short-term trading. just as today has worked and focused as the same type of reference. Now, as you're thinking about this market, you say, okay, if you see the report I put out this morning, I marked the 1955-50 level, and I marked that. That was one level. I also marked the 3-day high, but I marked this level because those were the highest highs prior to the all-time excess high established on 6/24. So unless we start these highs, then we can target the all-time high. If
Say
we
that,
fail,
Jim, I'm sorry, you just blipped out for a second. You said if we start, and then it went blank.
If we get acceptance above this 1555.50 level, then we have an opportunity to challenge the all-time excess high. For right now, we have looked above the 1555.50 level. We've looked above those highs. We've come back into the 3-day highs, and we're selling off a little bit. Still not definitive, but the low this morning, the early morning low, which coincides to the low of the base, it's kind of our reference for today. So again, you know, what we're talking about is a way of thinking when you talk about the markets. It's, and this is constant. If people all the time, and of course people have been with us for quite a period of time, know that we specific entry and exit levels. And my point is, if there were specific entry and exit levels in places to put the stops, they would be arbitraged away immediately. I mean, you didn't have to think about the market. You know, you just put your order in there, you put your stop, and away you go. The markets don't work that way. And if they ever worked that way for any period of time, everybody in the world would pick it up on their computer. It would be arbitraged away immediately. As I said earlier, I seriously doubt if there is any system or algorithm or anything else that has picked up this reference, the base of this spike. If somebody knows about somebody that does, please let me know, or has picked up the base of this spike right here. Now, sometimes these spikes may coincide with some other technical level, but we're about thinking about the market. That doesn't mean we don't have reference levels that we would say this is a reference level, because if we get down below this, something has changed in the way the market is thinking as a whole or as a composite. If it doesn't, then it's still thinking the same way it did on Friday afternoon. Unless we get down below here, it's thinking about the same way it thought following the FOMC announcement. So it's very important. And just because you don't like the market or the rally, or you do like the market or the rally, guess what? If you start reading market-generated information, you're going to have a much better chance. And again, this goes back to habit. One of the habits, I have another client, or we have another client, been trading for a lot of years, and slow to come on. It took him 2 to 3 years to really become a solid client. But once he did, he said now, as long as he stays with market-generated information, he's fine. When he lets his other cognitive biases creep in, he said now trouble starts to come up. Okay, Julia, let me take a small break and answer some questions. I want to go back to the slide.
Okay, Jim, you're okay. Yeah, for some reason it's just sometimes you just go dark. It just kind of goes out, but that's all right. You're back, so we'll just let you know when we have that happen.
Okay.
Could you? That's okay. It's not your fault. It's just the internet. Could you make today's profile larger? We have a question. We have 2 about acceptance. So let's start here. So the B, C, D periods above the previous high this morning don't count as acceptance.
Okay, again, let's not be so exacting. What do you have on the very high? You have single prints. You looked above this all-time high, and you have some single prints. Yes, you can technically say
not an all-time high, though. Excuse me,
no, I'm
sir.
sorry. The highs prior to the all-time high.
Okay.
We looked above it, and did we get rejected out of it dynamically? No, but there's single prints above it. Remember, one of the things, and this goes back to when I kayak and when I kayak in cold water. One of the first things I learned about is you never wear cotton, because cotton kills. You know, cotton holds the cold and things like that. You got to be very careful. And one of the things, I took that and I said, part of the thing in trading, exactness kills. If you are demanding exactness, that will kill you as a trader. It's not a science. There's more art involved in this. There's thinking, there's psychological factors in here. So, you know, the excess on the high is more important than the fact that we got triple and double prints just slightly above that. Okay, so it's not exacting, but again, there was some rejection up here. Now you go to the next step and you say, but guess what? Value is clearly higher, and we haven't gotten any acceptance down here. So right now, I have a little excess low and I have a little excess high, and I'm just about the center of the range. Okay, additional questions?
Yes, thank you, Jim. And it also bears reminder that we have a 6.5 point range. We know that's very unlikely. Well, we've seen it, but the odds are that we'll see some breakout. We could have a double distribution day. To just follow this gentleman's thought, one more iteration. In that case, when does Jim consider a, quote, tail in place?
The tail is in place on both B and A and B and A.
A. You mean, you know, B. B. What, there is, okay.
Well, there's one down here in A and there's one up here in B. You know, it's not a science. Look at how it develops. Look at how it develops. Look at the volume right at the top. 18 contracts at the high. 1465, 17, 9600, 17,000. So I mean, there's other things. What happens? What ties traders up so much is trying to be perfect, trying to make a science out of it. It's not. You know, now today value is higher, clearly higher. This is held, so the auction was up, and now it failed up here, it failed down here. Now you're right in the middle of the range. Okay? That's what it is.
Yep.
There's nothing more to it.
Okay. We had a comment from a woman earlier that when you were talking about the Tuesday high from last week, when it took out the overnight electronic all-time high there, if you could point to it on your chart, Jim, that she said she was looking to get short there, but she started listening to someone else, and they were saying, oh, it's going, you know, and it confused her. And just to let everyone know, we do have an article on our site that's called Protecting Yourself, and it's really Jim writing about protecting yourself from me and other people, because even there you knew what to do, you had it all lined up, and someone you listen to says something and it starts to make you doubt yourself. I mean, how many of us have had this happen? Countless times, more times than I think we care to admit. But that's something that if you wanted to reference that article, I just want to put it out there since you brought it up and mention it to the group for your edification.
Yeah, the article was really based upon how do you protect yourself from me and my biases, because I have them just like everybody else. Part of the thing is you have to think for yourself. Now remember when we talked about earlier on, we talked about sequencing. Think about sequencing. We're up here and we have a new all-time high, and it's made in the pit session, not in the electronic session. Okay, then the market balanced. Now, as I was telling this, I don't usually recommend leading in the wind. I was leaning into the wind on this because I read it right. I thought the poor lows down here, and I thought the volume, and I got lucky. But there's a whole another way if you think about the sequencing. Okay, we made a new all-time high. Now the market moves sideways, and you got the high here. EF. What happens in G period? Something changed. Remember, it's the two-way continuous auction process. So when you come out of this, you can go with this G period break. Balance and excess are the two most important concepts embedded within market-generated information. Here is excess. Excess marks the end of one auction and the potential beginning of a new auction. The continuous two-way auction process, once we have excess here, then the market's going to start testing to the downside. Now, that downside continuous two-way auction process may be very narrow. In E period, it just went a little bit and then went up to F, so it's narrow, and then it started to widen out here. But anyway, you had an excess high, excess and balance, the two most important concepts, market-generated information, embedded in what we talked about. Now, you come out of balance in G period. This is a great trade right here. Well, you say, well, Jim, but how do I know that? Well, you don't know that right now, but think about it this way. If you come out of here and you can put your stop up in here someplace. Once you break below F, you can put your stop someplace around the top of G period. And so your risk is very, very low. Your potential reward is down at least to the two matching lows from Friday and Monday, or Monday and Tuesday. I don't remember exactly what they were. But
Monday,
again,
Tuesday.
Monday, Tuesday. It is, again, it's a way of thinking about the market. It's a way of thinking about risk reward. Here you're talking about trade location here. You're talking about trade location here. And remember, we said as we go through the intensive, trade location is going to be one of the most important risk control tools that you have at your disposal. Just like this morning, trade location this morning, we said, as what the report said this morning, was the base of this spike. Okay, that was our trade location. So if I buying in here, my stop's just a little bit below it. Some people say, yeah, but Jim, we traded down here overnight. Yes, we did trade down exactly to the point of control overnight, but once the pit session opened, nothing's changed from Friday. This is my trade location. This is where I'm controlling risk from. Okay, a couple more questions before I go back to the slides.
Thank you, Jim. This is the last day of the month. Is this factor still relevant for the current session?
Sure. I've been writing about that. I wrote that 2 or 3 times last week. I'm just going on history. There's been several times in recent quarters, they have moved the market up coming into the end of the quarter. And then after the beginning of the new quarter, you see those marks taken back. Does that have to happen this time? No. I suspect that Friday's move was an awful lot related to that. Some people will tell you it was because the rebalancing of the Russell. I suspect it was just people positioning portfolios and value for the end of the quarter. There may be, some people trying to mark it up because they get paid on their performance, how much they're up for the month, or some people get paid on the value of total assets. Some portfolio managers may mark up portfolios because maybe they have some stocks that were real winners in the quarter, but they're not in their portfolio, and they decide at the last minute to put them in their portfolio. So, when clients look at the portfolio, when they look at the portfolio after the quarter, it's, oh yeah, they own good stocks. I'm comfortable with those people. There's all kind of games that go on. I told you before. And I've said so many times that trading's a game. Markets are very visual. They go to very visual levels. Trading is also very game-oriented. Whether they, it started years ago. Years ago when we were on the floor, there was nothing for short-term traders to gun for the stops on yesterday's high or gun for the stops on yesterday's low. As the market gets bigger, that doesn't mean they don't gun for all-time highs, gun for the weekly high or low. There's all kind of games that go on in the marketplace, and part of it is just don't fight it, just accept it and say, okay, how do I protect myself and how do I participate along with these games? You know, and part of it is by looking at the market-generated information, staying and trading with value. But I mean, I don't know what's going to happen. Although, you know, we did write about it, and we did punch the market up on Friday. Some people will say, yeah, but Jim, Wednesday was the last day you could buy stocks for this quarter. It's the last day you could have bought stocks for regular settlement was last Wednesday. There's other ways to buy. You can buy for cash. You can buy for 2-day settlement, 1 day. There's other things that can go on. And even if you have a portfolio, getting prices higher can benefit you. I mean, I don't know what went on, but I know I've seen this pattern. I've talked about this pattern, and what I was trying to tell you last week, be prepared for it. This is part of learning to be a trader, not having your head in the sand, but understand this is reality. This is what happens in markets. Okay, I need to go back to the slides, but is there let me take just a couple more questions first.
Great, thank you, Jim. How do you determine roughly when an excess is created? Is it with 2 ticks, you know, in on a profile?
My answer is going to be the same thing. It's not a science.
But at least 2 ticks. If we only have 1 tick, like, okay.
Yeah, mechanically, it's 2 ticks. But remember, what is also important is that when there is not an excess high, you have to learn that can be important too. And this is why what I've said so many times that, you know, when I first started to learn to trade, it probably cost me $250,000 learning about buying tails and selling tails. Probably took me 2.5 years to figure out the significance of when there was no buying or selling tail. Many times, so much short-term trading revolves around inventory imbalances. So when I get a poor high on the 20th, or whatever day this is, these are off my 1 day, inventory probably just got too long in the short-term time frame, and they had to liquidate that inventory. So a lot of times on short-term trading, that somebody pointed out, it's not uncommon to have 3 moves throughout a day. And most of those moves, you may have the market go up, come down, go up. It may
3 rotations.
3 rotations
clear
throughout the day.
Options, yeah.
3 rotations, and you know, and all of those may be related to a market getting too long or too short. Let me show you a move from Friday. I'm going to break this out. Let me see here.
Could you close Tuesday too, Jim? And just to mention, I think Window Trader is having a problem with Microsoft Cloud today, and we may have lost data, just so people are aware that we might have to go to CQG when we go back to live markets, Jim.
All right, take a look at Friday. We are 1, 2, 3, 4, 5 wide up here. No, I'm sorry, 1, 2, 3, 4, 5, 6, 7. We get a break in H period. Now, when I came into Friday, the market rallied, left a poor high, came down and left a poor low. In other words, no excess here, no excess here. The market went up here and stalled. Notice it was right below the excess from Thursday. The market moved, it traded sideways for 4 hours, 2 hours, 4 periods, broke. Well, I think what happened, we had a poor low. So when you're talking about, you know, these factors that you have to put in, I was cranking in the poor low. The market went up here, moved sideways. I think inventory got too long. Then you get a liquidating break. Look at this liquidating break in H period. Comes down and cleans up the poor low. So I think the market probably got too long, broke down here too short, and then you got the late rally, which You got them short off the lows, short off the bottom in here, and then what? You got the break in H period, then I period came down, and it looked like they were going to smash them, and they got 2 ticks from the low, and it was gone. So I think it went from too long to too short to too long, probably also tied in with what was going on at the end of the quarter. But that stuff goes on all the time, but you have to be thinking, constantly thinking about the market and what's going on. Okay, one more question before I go back to the slides.
Okay, thank you, Jim. FedEx guy just came. Seeing the excess high today, was it okay to short the market for at least a move back to half back?
Hold on, we're cutting in and out.
Can you hear me now?
Yeah.
Seeing the excess high today, was it okay to short the market for at least a move back to half back at the beginning of C period, or would it be too early because the high could be taken, just in C period? Hello? Okay. Can anyone hear me? But you can't hear Jim? Okay. Jim, we can't hear you. Seems like your internet's bogging down. Thank you, everyone, for your patience. Just give us a moment here. And I think in terms of, to keep this thing rolling, there's nothing wrong with trying to short in C period. Is it Jim's trade? No, he probably would want to see a little more. It's a short-term trade. Some of our traders trade 40 times a day. They're institutional traders. They have low commission costs. Some traders are looking 2 to 3 trades a day. We know that Jim tends to do 1 to 3, 2 to 4, 4 even pushing it. But as long as your trade location is good and you're not someone that gets married to your trades and you can't let yourself get out. But if you put it above the B period high and you want to give it a shot and you think it's weak or that there's something on the downside, at least to half back, okay, but half back was what? 1953.50, you're getting in at what, 55.75 for you so you're looking for a pretty quick hit there. If that's your game, if you can get out and be disciplined, go for it. Obviously, we didn't come here to listen to me today, so let's just give me a second. I'm going to call Jim. I might have him call in on the phone. Hold on, everyone, just one second.
Are you okay there? Do you think calling in on your phone would work better?
I'm trying to go to my jetpack, but I can do the phone.
Okay, I think we're now on the webinar, so I think we're good. You're cool, Jim.
Am I back?
Yeah.
Oh, okay. Okay, Julia, can you hear me? Testing.
Yes, I can hear you.
Okay, okay.
Jim, just a quick, I beg your pardon, I've just been talking to myself. My mic was on mute. Someone asked, can I short the C period? And when I had answered it, which I think you would agree, yeah, you can, as long as you don't get married to it, and it doesn't give a lot of downside if you're only going a half back. But if you want to do it, as long as you're not the type to get stuck in a trade and can't get out. And we had other traders chiming in, I shorted it, I shorted it, I shorted it. So is it okay for Jim? What do you have to say about that?
It's the same thing we've always said. It's a short-term trader that has mental flexibility. It's a short. It is a legitimate short, with the destination trade being the early morning low. As you can see, the D period low was just 2 ticks off the early morning low. So it was a very legitimate trade. As Julia said so astutely, if you're going to get married to it and think you're going to get a home run, and that's what you really want, then it's a problem. But if you're flexible, say, okay, once I get below it, I have to stay below that, and I have to get downside continuation. And in the trade location, the optimal trade would be down to the early morning low. It's a very legitimate trade. We have I was reading something put out by a new trader. Somebody bought the Platinum package, which is a combination of both sets of DVDs and the intensive, and they're doing very well in the market. But I was reading his comments the other day, and he was talking about something we talk about all the time. Had a losing trade, and it was based upon not what the market-generated information was saying, but what he wanted to have happen, not the reality of what was happening. And that's something we have talked about time and time again. When this market at C period, very legitimate short, and the destination trade being the lower end of the early morning range, and once it gets down there, you should take it off rather than sit there waiting for the home run. Mm-hmm. Because it didn't have, if you're going to get out of this and get the home run, you're going to have a lot more confidence and you're going to have a lot more volume in the trade. Just we talked again about, when we go through the intensive, trying to teach you how to think about markets. One of the things that we're constantly working with the intensive is to understand who's in control of the market. For example, when you look at today, who's in control of the market today? It's all short-term traders. Okay? Short-term traders, they're going to buy highs and sell lows. That's that's their behavior. That's one of the things we need to understand. Now, what'll mess people up if all of a sudden, they're trying to trade it like a short-term trader, but it's not one of those days. It's a day when the long-term traders, or at least the short-term traders that have, 100 million plus at their disposal, are now on a major trade or a major liquidation, or there is longer-term money. Then the behavior of the short-term trader isn't going to mean much, because on a day like today, the short-term traders will be trying to buy highs and sell lows. And I mean the daytime frame traders. On a day when the market really has some conviction, directional conviction, then what you're going to find, the daytime frame traders, they're going to be jumping on board. They're going to be jumping on board, going with what's being done by the next longer time frame. So it's constant questioning yourself. Who is in charge today? And today it's the short-term traders so far. That is going to have an awful lot to do with how you trade, and what kind are you looking for? Big opportunities, small opportunities. You're going to be buying highs, selling lows, or you're going to get range extension. That is so important. And when we go through the intensive that's coming up, as there's about 8 hours a week or so where I'm live like now, but I also have a one-way chat room where I can constantly put out messages that come on your screen on the chat. Then, and what I like to do in there is remind you. I might say this morning, we looked up above the multiple highs and we got rejected. I might say, we broke down to the D period low, but there's no evidence that there's any major change in the market. Value's higher, and there's no acceptance again down at the early morning low. Or it may say, this is a very quiet rotational day. No big opportunities. Another day, there might be totally different. You might say, wait a minute, we are one time framing higher. You know, do not try and catch the falling knife. Don't stand in front of it. So what we're trying to do is go through and help you understand and appreciate how to think about the market, how to approach the market. Okay, let me go back.
And just a quick thing, you had said buy highs and sell lows, and of course people are paying attention because they're joking with you. But you meaning buy lows and sell highs, obviously, for anyone that might have not understood that.
That's right.
And
when the short time frame traders are in, the daytime frame traders are in control. That is correct. Thank you very much.
And just give me 1 second. In C period, Jim, to get back to that question about can I short it, we have a gentleman asking, in C we were above the 3-day high with value building higher. Why would that be a short? I could...
well, we've addressed this a couple times. You got single prints up there. This is the question. This is the question. You said, well, it's being accepted. I said, well, yeah, we had it was 3 wide, 1 tick up there, and 2 wide, 1 tick above it, but we had 3 single ticks on the top. So we had a little bit of a selling tail. And it's a day where trading is very quiet. And people are asking, can I try a short today? The answer is absolutely yes. You looked above there and there was no great upward continuation at that point. So it's a very legitimate. But you say, but it was getting accepted. But remember what we were just talking about a little bit ago, the thinking. You also had a selling tail up there. It's a continuous two-way auction process. If the market goes up and it looks above those highs that we had used as a reference, and you get a little selling tail, well, guess what? The next part of the continuous two-way auction process is going to be the downside. Now, it may only be 4 or 5 ticks, who knows? But in this case, it went all the way down to 2 ticks below the low. So this idea of when you say acceptance up there, and I'm saying yes, but you had a selling tail, my guess is that what was going on in your mind was what you wanted to have happen. You were probably long, and you wanted the market to go higher. Though that is a crucial trouble spot for all of us. What we want to have happen versus what the market is telling us is happening right here. And the market was telling us that at least at that moment in time, we don't know later today, at that moment in time, we had a little selling tail, so we probably got some liquidation, probably some inventory liquidation up there. And then that liquidation carried the market all the way back down to 2 ticks above the early morning low. Once we got back down there, the rotation started back up. It's a nothing day. As Julia said, it's in a very narrow range. More than likely, you're going to get constant rotation from inventory being too long, too short, etc. Okay.
Yeah, and can I just say too, Jim, we had this come up in the intensive a couple of times. Well, people getting frustrated. Why is Jim saying it's okay to short? Sometimes the ruling reason is trade location. You have an asymmetric opportunity. Why not try it? I mean, if someone said, look, you can roll the dice, it's a 50-50. You lose nothing, you gain $1,000. Why not? It's a 50-50 shot. That doesn't make sense. That's not a high probability trade. Well, considering the odds or the trade location or the amount of win versus loss, you put it on. Yeah, roll them. What the heck do I have to lose? So it's not, I mean, yeah, value's higher. We're above the 3-day, but it's, the tempo is poor, the confidence, the directional conviction, they're not really supporting the move. And if she wants to try a short there, which many traders in here did, they're out with a few ticks and they might get the bottom of the early morning low. Why not? It's just a personal preference, but it's difficult to try and put these concepts into one trade and say, well, value's higher and we're outside the 3-day. I understand what you mean, but at the same time, it just shows how many, how the fabric just gets woven together and how our own psychologies and risk appetite come into play for any given trade. So I've gone on and on, so I just had to say it.
There's a calmness that's needed about trading. When you look at the market this morning, the market really was not a high confidence market. We went down exactly 1 tick above or so of the reference. The rotation up was slow. We looked above yesterday's high. We came back in. We looked above. We went back up. We finally got up, following the housing report, we finally got up above those highs, those highs we talked about. There was no follow-through. The base was very narrow, and the chances are fairly good that you get a downward rotation, if nothing more than an adjustment of inventory. Now you have to remember, because you're trading against the trend, you're trading against value for today. If you do the short, you're only leaning on short-term, the short-term reference, which was the excess high, the little selling tail up there, but you're against value, you're against everything else. You have to be right very quickly on that trade. So that's what you say. You have, if you understand that and you have mental flexibility, you can say, okay, my risk is very small. I could trade down to the lower end. It's a legitimate trade. If you're not comfortable with that, then you have another thing. If you're long, there's a difference between exiting a long and going short. And if you're long and it gets up above those highs and no follow-through, you probably want to exit that short-term long. Then when the market goes back down to just a couple of ticks below the early morning low, then you can trade with the trend, you can trade with value, and you can become a buyer down there. There is no one answer. It has to do with how you see the market, how mentally flexible you are. The more you're going to do short-term trades, the more you're going to need to be mentally flexible. Julia, you started to say something.
No, people wanted to show the charts, but I know you're trying to get back to the presentation, yeah. But it's just, I mean, you have got to look at things holographically, holistically. You look on a ledge, you're looking out over a beautiful vista. Do you take it all in and feel how great it looks, or do you look at a car down in the lot and say, well, that's not right in here? I mean, it's just, I don't know, I don't mean to, I feel like I'm pontificating or preaching, but there's so much more to our decision making than just trying to compartmentalize these concepts and make it a rule-based system. And like Jim said, many times we're doing that because we have a bias and we're trying to support it. And sometimes it's very insidious, it's very subtle and difficult, and we've all done it, so I don't say it with judgment. We've all done it. I've done it more times than I'm going to admit here, but it's just really having this self-awareness. And I think it goes back to Jim saying with the guy who said, well, I'm not going to do this intensive because my market understanding surpasses my self-understanding. Well, guess what? Your self-understanding gets better when you have better market understanding. And, you know, getting coached is a huge deal. I mean, look at all the professional athletes. They got strength coaches, nutrition coaches, quarterback coaches, offensive coordinators. They got coaches all over the place, and they are elite. They are excellent, top, top, top. We can't have, as long as it's good information, too much coaching, mentoring. I know I get trained from a trainer, even though I know what I'm doing, but that keeps me really on my game and keeps me growing and pushing the envelope. Okay, I feel like I'm going on and on. Thank you for indulging me.
Okay, and speaking of that, you know, so much has to do with being prepared. It hit me this morning. In the last year, I have avoided being in serious automobile accidents, and I'm hesitant to say this because I'm leaving for California in a couple of days, which means I have to drive. But I've avoided 2 very serious potential accidents as a result of preparation. One of them was my dad taught, he worked for Illinois Bell Telephone Company for 37 years as a foreman and lineman, but one of the additional things he had to do was teach driver's education, because that was so important to, you know, these trucks are on the road all the time, and people see the color and they know what their telephone company. But one of the things he taught me was, you know, you're looking not just straight ahead, you're looking at side view mirror, you're looking ahead, you're looking at the rear view mirror, looking to the right, you're looking your left mirror. Constant. He said every couple of seconds you're making a full rotation of where you are and what's going on in the marketplace. And he drilled it into me, I mean, to the point where I do it just automatically now. I was on Interstate 8, which goes into San Diego, and it basically parallels the Mexican border. There was an accident on the opposite side of the road, and of course, we know what happens. Everybody starts to slow down, you know, to look at the accident. I was almost at a total stop. I was doing my routine, and all of a sudden, I see that the car in back of me cannot possibly stop. It was a truck. It could not possibly stop. Luckily, I had enough room in front of me that I hit the passing gear all the way down, and I wasn't sure if this truck actually hit me or not. There was a thud in the back, but it didn't feel like I got hit. And actually, what it turned out, it was just my suitcase had slid. I have an SUV, and the suitcase had slid and hit the tailgate. But it was that close. And the guy came up alongside me later on and just put his thumb out and kind of waved thank you because he wasn't paying attention. But it was the preparation. It was the preparation. Just a few weeks ago, I'm in the HOV lane, the high speed lane, and all of a sudden somebody comes out in the lane at a 45-degree angle. How in the world I was able to turn left, miss the cement divider, get back to the right, get straightened out? It all was instinct. I learned to drive on a cut wheat field. I don't know if there's any farmers in here that ever driven a car on a cut wheat field, but that's where I learned. And my dad would take me out and, you know, teach how to spin a car, because a cut wheat field is just like ice. But how to maneuver a car and how to feel. Additionally, I had both hands on the wheel. I was paying attention. I was not checking the radio or anything else. So the preparation, the training, had a lot to do with staying out of two potentially difficult situations. And that's really what you can do. We talked about the book Habits as we started this. And part of that, and we said, one of the things we said is the key is to replace bad habits with good habits. You can't undo the bad habits, but you can build new habits over them. So one of the things we do is try and gain a top-down perspective of the market. We want to end up with at least 3 potential trading scenarios for the next session. And we want to identify, if possible, a ruling reason as we begin to enter the next session. Now, we talk about 3 potential trading scenarios. Guess what? It's unlikely that those 3 scenarios are going to be slightly higher, moderately higher, and drastically higher. That is not what I'm talking about, 3 scenarios. I'm talking about 3 scenarios that are related to the current market. Some may be up, some may be down, some may be sideways. But, you know, and we talked about the sequencing is going to be relevant. So you may try one way first, so one scenario, and then that runs its course, and maybe you go back to scenario 2. But being prepared has an awful lot to do with being successful in the market. And so what do as we go through this routine? We start with a monthly bar. And I'm just going to go, and we're going to go off the charts, because we're going to go monthly, weekly, daily profiles. I'm just going to go off of these. I'm going to go to my bar charts. Before we do that, let's just see, market's still about halfway back. Okay, I'm going to my bar charts. I hope they're working. I'm going to go to the S&Ps, and I will start with my bar chart. I'll look at the monthly. Okay, there's the monthly, and it doesn't take long once you do this. Where's the monthly? We had an excess low back in February. We had another excess low in April, and the market is 1 time framing higher. Doesn't take long to see, you know, we're just off the all-time high. What's the trend? The trend is clearly up. That doesn't take a long time, but you should constantly do it. Next, I go to the weekly. I go to the weekly, and I say, oh my golly, look at this. There's an excess low. 1, 2, 3, 4, 5, 6, 7, 8. This is the 9th week in a row that the market is 1 time framing higher. Now, when you're talking about your trading and having some idea that the long-term trend's up, the weekly trend is up, you know, why do you want to fight those? Why do you want to fight those? But so many times you hear people, I had NPR on the other day, and I heard some guy come on, and he was talking about how drastic the market's going to fall. Maybe it wasn't NPR, it was one of those guys. How drastic the market's going to fall. Well, he may be right down the road, but that's not going to help you right now, because that's not what's going on right now. So I look at this, and I got a perspective. I say, wait a minute, which way is the market going? Everything is pointing to the upside. I then go over to the daily. Let me go back to the weekly for a second. When I go to the weekly, I will mark, as I get ready for this week, I will mark last week's low at 1936. Okay, we've got, this is a heavy week for news, and we've got, it's a shortened week, 3.5 trading days, half a day on Thursday, but also you've got the employment report coming out on Thursday morning, and you've had some questionable numbers recently. Now this morning, you had a little softness in, I think it was PMI, and then you were to the plus side on pending home sales. So there's been some conflict going on in these numbers. You remember the last GDP number was very soft, but then they blow that away and they say, well, but we're going to get 4% anyhow. Well, there's a lot of confusion out there. So a lot of numbers this week, big heavy numbers, and with the employment number on Thursday morning, plus it's a half a day, thin markets. So one of the things I certainly want to keep in mind, last week's low. If there's going to be any meaningful change this week, we're going to get down below last week's low. So one of the references I'm going to want to carry forward is going to be last week's low. So I'll mark that down, 1936. Now I'll go and I'll look at the daily. All right, there's the daily. There's the low I was talking about. That low coincides with the top of the spike on Fed Day. And remember, we said it's unlikely that people will have the weekly low. So by coincidence, people will have the weekly low while we're using the Fed low. So that's way how two of us could be using the same number. We got it long before, looking at when things changed with the spike on this day. But I'm looking, I see the all-time excess high. I'll mark across these highs. I looked above it this morning. Well, does that hold or not? I don't know, but I have an all-time excess high. We talk about scenarios. One of the potentials is we had a test this morning of the all-time excess high, and that test turned out to be successful. Okay, I'm not saying that's what happened. I say that is a potential scenario. So if I look at it, I'm still on the daily, but a potential scenario is I had a test of the all-time high. The test was successful. The next rotation will be to the downside. Another scenario could be there was this high this morning. It poked its head up above it. No follow through the downside. I'll be back here, go for that all-time high later in the week. Another potential scenario. But you can see from both of these, I'm getting myself prepared. So when I look at it, the two references I've used, I'll use three. I'll use the all-time excess high. I will use the weekly low, and I will use this 1955.50 level, which measures these highs. Now, of course, I have a little bit above it today, but this will be my reference level in here. So as I go through this preparation, I'm thinking about what could happen. I'm thinking about the week ahead. I know it's a shortened week. I know it starts a new quarter. Okay, I know there's a lot of news coming out, and I want to be prepared for everything. Right now, all trends pointing to the upside right now. So I said, what would be the first indication? What would be the first indication that there's change going on in the market? We're talking about a larger change. First indication is going to be that I get down below last week's low. I mean, for anything really major, that would be an indication that, wait a minute, maybe something far more serious is brewing. So I go through the monthly, the weekly, daily. I make sure I note those references. I put them in a piece of paper, and then those that are nearby. As I get to the daily profile today, then I start, and let's go back over here. Then when I get to today, I look at the overnight high or low. But I look and I say, okay, I've got, this would be a reference down here. The same reference we saw on the other chart, these multiple highs at the 1955.50 level. We already had those. A new one we'll add is going to be the spike, the bottom of the spike from Friday. You can either call it 1950.25 or 1950. It's a tick difference in there. So that I'm going to add the very prominent point of control that has not been revisited. I'm going to add the prominent point of control down here that's not been revisited. You know, I'm going to continue, and I've got an, and then I'm down. I'm going to have Friday's low, the point of control. Then I'm going to have down to the weekly low. So I will have a series. I will have a series of references as I prepare for tomorrow. I'll have a series of references. I will have looked at the monthly. I will have looked at the weekly. I will have looked at the daily. I will look at the profile. I will have marked my references. Some of those are more important. They're longer term. The weekly is a longer term reference relative to my trading. The daily high and low are much shorter term. This looking up above the 1955.50 level, that may be an intermediate term. If I don't get back there, that may be an indication that that's the end of the intermediate term auction to the upside. So, I mean, I just keep working through, this process. And hold on, I'll get there in just a second. And we're going to daily. Short-term trend, up or down, long-term references. We're constant. We want to mark our references. We want to make sure we know where the trends are. We want to know where change would take place. For example, we'll put in change would take place this afternoon if we got below the base of Friday's spike. More serious change would take place if we got below the spike on trend day, the base of the spike on trend day.
Jim?
Yes.
Just, excuse me. Jim, to answer a question, thanks, Chip, for asking, it's all pit session bar charts and profiles. Thank you.
Yes, it is. Yes. The only time I use the other is when an all-time high or low was made in the electronic market. Then I will, if I still use the pit session, but I will mark that electronic high. I use the pit session highs and lows, but then on the profiles I put the overnight inventory high and low, so I have that reference. That's how I work that in. Okay. So when I get all done, I look at the profiles. I'm developing my daily potential scenarios. What would I look at this morning? One scenario this morning would be that I would have support. I would have support at the base of Friday's spike. Okay, clearly would have been a scenario. And guess what? That's exactly where support was. So another scenario would have been I got rejected and I trade sharply down below the base of Friday's spike, which then would target the very prominent point of control from Friday. Below that would target Friday's low, and below that the prominent point of control from last Thursday. So that would be another scenario. And of course another scenario, the market just does nothing, it moves sideways. Well, today is kind of a combination, moving sideways, last day of the month. But I'm constantly thinking about those things ahead of time, so I have some kind of thought pattern coming into the market, so I'm not trying to make every decision based upon what is in front of me right now. Okay, pre-opening review, we're talking about these are habits. As we get into ready to go for the day to start, is overnight inventory long or short? That's what I'm doing prior to the market opening. So like I said, we came in on Friday. If you got the report, it said my initial ruling reason on Friday was the overnight low. Overnight low was taken out. Where was the market? To the upside. Okay. Next, expected opening based on overnight trade. Does it look like I'm going to open in balance yesterday relative to yesterday? Out of balance? Out of balance to what degree? the maximum out of balance degree would be a spike. Then we'll start talking about the spike rules.
A gap.
I'm sorry, a gap. I'm sorry, thank you. Do we open out of balance? The maximum opening out of balance would be a gap. Then we start talking about the gap rules. And the gap rules are, if the gap's not filled fairly quickly, okay, go with the gap. If the gap is filled, unless you're going to get value at least moving to unchanged, and let's say the gap was higher and we close the gap to the downside, and the rule would be, okay, if value isn't going to be at least unchanged, then the chances of a later rally that day are very high because value would be higher. So we're constantly going through that, and we're getting our preparation prior to the actual opening of the trade. And why? As we teach so often, you open in the middle of yesterday's range, the odds are you're going to have very little opportunity. You're going to have short-term opportunities. You're going to have a lot of rotation. You open at the top of yesterday's range or gap higher. Well, now the opportunities are likely to be very, very big. Either you're going to move pretty well to the upside, or you're going to open a gap higher or open to the end of yesterday's range and not get upside follow-through, but all of a sudden start to get, downside correction. So you're constantly trying to position yourself ahead of the actual opening price. Is this going to be a wild opening? Are the opportunities going to be big or small? Do I more than likely want to trade early, or do I want to trade late today? That's a big one. I think if most traders that are not successful, if they will go back and they will review how many trades they do within the first 15 minutes to a half an hour, I think you will find that there is just an awful lot of pain and financial loss that takes place from people over trading in particularly the first, half an hour or so. And, the exception is if I open within the middle of yesterday's range, this is not the exception. If I open within the middle of yesterday's range, more than likely I'm going to want to trade late. I'll let the market set up. I'll let it just go back and forth and let everybody investigate. And once the market seems to have a tone, then I'll enter late. I'll have a little bit more information. If the market has a high level of confidence from the opening bell, then I'm probably going to want to enter early in the market. But if I'm close to the range, to the upper or lower range of yesterday when I opened, then more than likely, I want to be very careful, but more than likely the opportunities are going to be bigger, and I may have to act on them a little bit faster. When we go through the intensive, some of these will take place in the opening, but I also remember I will have the chat room. I will have the chat room, and I will try and make pertinent comments. I'm not there to tell you to buy or sell. I might just say, it seems to be low confidence in here this morning. You might want to wait. I mean, those are all, these are habits that you get into. They're forms of discipline. How do you handle the trading day? How do you manage your own expectations? Managing your own expectations is huge in the marketplace. Somebody said earlier, but the market was being accepted up there today. And I don't know if I was right. I was guessing that somebody was wrong along and wanted to go higher. Their expectations were for it to go higher. If I'm looking at market-generated information, I may say, I've got a selling tail up there. I got rejected. I may want to step aside from my long bias right now. I know from my own personal trading, when I am trading on market-generated information, I do really well. When I can't get away from my own biases, it is very difficult for me. And then I sometimes get stubborn. I mean, but sometimes I say, woo, I've got to go flat. I got to go flat. I got to get my mind together, or get out of the market, take a walk, get rid of these biases. It's not easy. There's a lot of emotion, and when that price, one of the habits you need to break is the old habit of following price. Remember, price is nothing more than an advertising mechanism. All it is an advertising mechanism. Price advertises opportunity, time regulates those opportunities, and volume measures the success or failure of those advertised opportunities. Again, one of the habits that you need to build over, you're not going to get rid of following price, but you need to build a market-generated information habit over price. I think you will find it will make a substantial difference in your market understanding, your self-understanding, and your results. Again, just kind of an overview, the habits, pre-opening review, see them at market overnight inventory, long and short. Expected opening on overnight, based on overnight trade, because just as the overnight closes, we know where we're going to open within the day. In balance, out of balance, we're just reviewing. Do you have your references? Have you put all your references on the chart? So if the market starts to do something unexpected, you're not running like a madman trying to find out, well, where's the next reference, what I'm looking at, or forgetting about it. I forgot about it once last week. Terrible, terrible mistake on my side. On the day that the market looked above the all-time high and came down, I had a superb trading day, one of the best I've had in some years. I just read the market all the way through. Well, then the other day, when the market looked below the base of the spike from Fed Day, I had let myself get too trapped by how fast price was falling in the morning. And let me set up kind of what happened. I got short immediately at a beautiful price. I covered far too early. When I covered far too early, that started to trigger all kind of ugly psychological things going on in myself. I'm mad at myself. I want to buy them. I want to buy it to show them they're wrong. I mean, all of these things that have cost me so much money in the past. And then when it looked down below the spike and came back in, then I'm watching for a rally. It rallies up to half back, and I'm dying to sell it because that's where I missed out early in the day. So I want to get back on. Well, guess what? What I overlooked or didn't give proper attention to, we failed below the reference. So then all of a sudden, and it wasn't anything major, but it took a tremendous psychological wearing on me, along with a little bit of financial pain. But the biggest thing was the big opportunity. But it got everything in me going wrong. I got sucked in by price, along with getting out too early. And these are the things that happen to all of us. These are the things, and these are what we have to guard against. And just because I had the reference down there, you still have to look at them. Anyhow, enough of that. But these things happen to all of us, and we're constantly working against it. So the market is open, and you're looking for what is the confidence around the opening. So the references relative to short-term trading are the opening itself. If the market is high confidence, you will not come back to the opening, or maybe you'll only come back to it one time, and then you'll move directly. The more you're back and forth through the opening, the lower the confidence is, more than likely, the longer you're going to want until you trade. Unchanged. When the market reached unchanged from yesterday, that is going to be a day time frame, short-term reference. If it moves to unchanged and goes above it, all these charts will be green. If it moves below it, they'll be red. Overnight high or low, previous day's high or low. Dynamic references, these are references that develop because you get heavy volume in different places. And then you're constantly asking your place, are you in or out of balance? These are all things that I will try and constantly bring to your attention when we have the chat function. It may be nothing more than, hey, we're still in balance. We're close to the middle of the range. All it is, a lot of times, it's just a wake-up call. It's just a wake-up call to break that trance you may sometimes get into when you're looking at just price. Price is a killer. And it's easy to watch. It goes back and forth. It moves like crazy. Then you say, oh, I'm going to put the ladder. Then you say, oh, I'm going to use a 5-minute chart, a 15-minute chart. I find when I do that, I get too narrow. I'm much better off with a 30-minute chart. You're asking yourself, is value going to be developing higher or lower? It's a general rule. I want to trade with developing value. What time frame is in control? Like we said today, basically, it's the short time frame. It's the day and short-term time frames today. I like to develop an abbreviated notation key to what is happening. Now, I don't want to have a book. I don't want to put it into my computer. I like a piece of paper next to the desk, and I may say confidence. I may say, you know, CH, confidence high, CL, confidence low. I might write, you know, in balance, out of balance. One of the biggest traps is when, say, for example, overnight inventory is long, just an example, and the market corrects overnight inventory, and once that overnight inventory is corrected, the market then turns and moves higher. That is one of the biggest traps in the world, because you correct the overnight inventory and you lose track that all it was an inventory adjustment. We will try and point those things out. And you're always asking yourself, you know, what is possible today? What is possible? For example, the other day when the market was looking at the up, and I'm looking, so what's possible today? What's very possible we're going to the all-time electronic high. We know it's up there. It's very visual. We've been talking about it for a long time. Again, go over these things. Go over these things. Get yourself as prepared for the intensive as you possibly can. Going through this, look at this again. Think of these references. Get yourself mentally prepared so that it's easier to give instruction. It's easier for you to see if I'm wrong. And hopefully it becomes a very profitable experience for you. You know, you're going and following the opening. Is value developing higher or lower? What's the trend? Confidence high or low? Is there a tone? What's the volume? What's the structure? What's the market acting like around the references? These are all things you can do to get prepared. And remember, you can control risk. You can't control the profit. Let's go back. Well, I'll get there in just a second. Trade location, trading with value. If trading against value, use both structural stops as well as time stops. Let me go to the market, to today's market. We talked up here this morning. When you're up at this level, there's your, if you're going to short this market, your stop is someplace up here. But also, let's go back over here. Let's say you were long the other day and you really thought this market was going higher. You have what you want to see happen, you need to have this taken out. You need to get upside continuation. The other thing is a time stop. If you're long, the longer the market sits here without going higher, the greater the opportunity that the market is going to start to trade in the other direction. And mentally think about it. The longer you sit here without doing anything, there's a lot of people that are long. The longer they sit there without getting additional reward, the more nervous they get, the more likely there's going to be a liquidation break or a correction to the inventory. So you have both physical places for stops, structural places for stops, as well as time. You know, the market regulates itself via time. We got down to the lows this morning, no downside follow through either in time or, you know, in volume. Okay, let's go back and just kind of wind this up. We've covered a lot of information in a very short period of time. Risk control, trade location, we saw it today, we saw it the other day. You want to trade with value. Trading against value, you want to use a structural stop as well as a time stop. But if you're trading, if you're fading value, you want to be right very quickly. Okay, most of you by now, we've talked about it. You know what's involved in the intensive. It's 8 hours per week. I'll be live. And usually we add things if it's important. Like I say, the chat dialogue will be out there all the time. You'll get the report at the end of the day, recap and preparation report, and you'll get a morning report. And of course, most of you know, if you've already signed up, you've got all the access to the prior webinars and articles, over 100 trading articles we've written. These are some of the other programs that are available. If you are just starting, there's a couple of package deals that make some sense to you. Julia, let me go back to the markets. Do we have a couple of last questions?
Yes. Would you be willing to look at crude for a minute? We have a few traders. It's I guess an interesting situation. I don't know if you want to check it out on CQG. So
okay,
it's
what do we have in crude?
Okay.
Crude is look below. You've got a gap. The gap is filled at
Want to mark that? Yeah.
104. What in the world did I do? I have no idea.
Click that B bands again, Jim. I think you hit the B bands one. No, the B bands one. Yeah. Oh no, then it was trend channel. Just click a bunch of the buttons until they go off.
I want that off. I want that off. But why did Fibonacci go back on?
No, it's not fib on there.
Okay. Here, let me go to another. I don't know what I did.
Go to another one.
Okay. Now I want to go to the bar.
I think overnight inventory too, having comments, was 100% long this morning. Obviously that's quite a ways back from where we're at now.
Okay. Finally get back.
Just take the text off, yeah.
That's what I'm trying to do.
None. Yeah.
Okay.
Oh, I'm sorry. Was inventory short? I might have gotten that wrong.
Okay. Well, right now, what I'm looking at right now, I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. I've got a 13-day balance, trading range. I have looked below the 13-day balance into a very large gap. First of all, I haven't traded this for somebody. It is highly unlikely that a gap of this size will be filled on the first attempt. Usually a gap of this size will take several attempts to fill it. The first time you get into the gap, the market trades into the gap, it stalls, and all of a sudden all the traders say, oh, the gap held, support held, and they come in and buy it. That's generally what happens. But your level, the base, the lower range of that is 104.95. So that is going to be our reference. Right now we're trading at, last is 104.82. So we're trading below this. So this is resistance. 104.95 is resistance. Get back up and get back up above that, then we're back into the range. We could have left an excess low down here, and the market could start rotation back up. Now let's go to the profiles.
So we had a comment that there was a poor high recently at 104.62, and that overnight was long with a B shape. Okay, well, we don't look at structure and overnight so much, but go ahead, Jim.
For right now, you have the market went exactly to the prominent point of control from Friday. We put this as in 4s. I don't know, I've always traded in 3s. Okay, so right now you have a double distribution day to the downside. Let me get this price right. I think that's the price I really want. That's the low, okay? So you have a double distribution day to the downside. My guess is what happened, you got down below last week's low, and you triggered some stops. Those stops, you triggered this set of stops, you triggered these stops, you got down here, you got the stops back here, at a poor low on the 12th, you got the stops back there. Now, the question that I see is, do you stay below the 104.94 level as the day goes on, or is this a downside breakout failure? So if it's a downside breakout failure, you probably trade back above 104.94, and you probably trade up high as FGH, so you close this lower distribution. Right now, it is a very difficult trade right now. The main thing like I said, I haven't looked at this. The main thing that hit me was when the gap is that large, the odds are very small that you fill the gap on the first attempt. That always goes through my mind. But you're down in that range. The prior low of that multi-day trading range now becomes resistance. Julie, you started to say something.
Someone's commenting, if you would comment, volume was light before the break, so that's why I didn't sell it.
And that's, yeah, and that's, I mean, I don't know. I haven't been trading it really. It's a holiday week. I haven't been that much into it. Let's spread this out. One of the things you need to consider, you talk about volume. We find a lot of times we find more reasons not to do trades than to do trades.
Yeah.
Here is the morning high. You have a BC balance. This is a trade that should be done. You come out of balance, do the trade. You've been one time framing ever since. G period was inside F period. The market never stopped one time framing value lower. You've got a poor low. I would say you stay with that trade, or you short it again in H period because you're coming out of balance. I mean, that's just if you're doing mechanical short-term trades. The key is this went back up to the prominent point of control from Friday, or very prominent point of control. You had this BC balance, go with the breakout. These are balance. Remember I said embedded within market-generated information. The two most important concepts are excess and balance. Balance is the start. When you come out of balance, it's the start of a new trade, a new auction, at least short term. So remember the balance trading rules. Either look below the balance and fail, look below the balance and go. So you go with the breakout, you put your stop right up here someplace. It is a very attractive risk-reward situation. Now, the market never stops one time framing. You get another little balance in G period, never any reason to come out of this trade, and then you get the downside breakout in H period. Again, either add to the trade, but stay with the trade. I mean, it's one time framing lower. Your reference should have said once it gets down here, the very visual trade is 104.94, very visible. It was a poor low at the time. I mean, I don't know what else to tell you, but it's if you were relaxed, this should have been some fairly simple trading. Go with the breakout from value, then your one time framing lower. Now,
breakout from balance.
Breakout from balance, I'm sorry. Now, the question would come as we got near this low. If somebody said, I didn't go with this trade, my reason for not going with this trade was because of the trade location too close to Thursday's low. If you you've got a couple things. Like, I might have been out, I don't know. A poor low down here, but a good place to put your stop is right up above, a couple ticks above the G period high. But go with the balance, go with the one time framing, keep your stops fairly tight. Okay, we've run over. Let me take a final question. Let me go back. Let's see, the S&Ps, we're back up. They're testing the highs once again. Another prominent point of control, we're testing the highs once again, and we know it's the last day of the quarter. Okay, let me get one or two more questions, Julia.
Thank you, Jim. In reference to today's market and the lack of volume, should we not take into account that this is a short week with a big holiday on Friday? Therefore, volume is likely to be light this week. On the other hand, with lots of reports coming out, if volume is low, then it may be possible for the reaction to the economic numbers to produce a fair amount of volatility.
That's right. I mean, to me, the first thing I'm looking at is trade location. We are near the all-time excess highs.
Could you slide it over, Jim, so we can see that? Just so people have that. Thanks.
Okay. The next thing, we're at the quarter end. I wrote last week a couple of times. We've seen this history of the market, getting gunned higher at the end of the quarter, and we've seen that gunning taken back later on, once the new quarter starts. Doesn't mean it has to be the first day. I know I've got a prominent point of control here. I know I've got a very prominent point of control. I've got a prominent point of control here. I got all kind of questionable stuff underneath this market. So trade location, end of the quarter, guess what? I got a lot of reports this week. I'm not going, I want to keep myself free from carrying a lot of biases into the rest of this week. I don't want to have this hero break. I don't want to have this gigantic, new highs. I want to stay loose. I want to say, at the end of the quarter, it starts over again tomorrow. It's a shortened week, and I've got a lot of news coming out. Just stay loose. Don't feel an obligation to have these huge biases one way or the other. Final question.
How does the fact that value is developing higher today relate to the fact that it is, however, just slightly below the important 1955.50 reference? Could you slide that over so we can see? I think that's the 3-day balance.
I mean, they don't.
No, I'm sorry. That's the two highs, right?
They don't have to be related. Probably the most important thing is you've got the all-time excess high. It's within striking distance. Okay? Value is higher today. All day long, the basic direction has been up. We went up. We got a rotation. We didn't take the low. We came back up. We're centered, pretty well of a balanced day. It's the end of the quarter. Just don't work too hard on relating, what's this with this? It's the end of the quarter. Just kind of relax, get loose. Remember trade location for multiple things. The all-time high, we've looked above all these highs. We've come back in, very low confidence day, very balanced. End of quarter, just kind of relax, get ready to go with the new quarter. Once again, I thank everybody for being here today. For those of you who have already enrolled in the webinar, it's been very enlightening, and we did today because to accommodate the people from Europe and Asia and Australia. You guys have been just wonderful. Huge increase of business there as well as the U.S. The biggest growth has been overseas. We want to thank you very, very much. And if you haven't signed on yet, you got a pretty good idea now what we do, what we're going to look at, and the things we're going to be emphasizing on is helping you think about the market. How do you think about the market? How do you get in touch with the market? How do you understand the behavior of the people that you're trading against? What do you do to prepare for a day? How does this preparation build new solid habits? How does this preparation and building these new habits help you overcome many of the self-understanding problems that we all have? I find that my new habit, which I've had for some years now, market-generated information, is very, very helpful to do away with some of the bad habits, like I say, that crept in the other day when all of a sudden, you know, I let myself come out too early. It creeps in now, and I wish to say it didn't. But all I can tell you is Julie and I will do our best to give you a very rewarding experience. So once again, thank you for being with us today, and we hope to see all of you over this summer intensive. Thanks again. Bye now.
Thank you, Jim, very much. Great job. And thank you, everyone, for being here. We will get this uploaded to the site if you'd like to review it, or if someone you know that couldn't be here, you can let them know it's there. Okay, God bless you, everyone, and good luck, and have a wonderful afternoon or evening, morning, wherever you're at. Okay, thank you. Bye-bye.